The broadest measure of economic activity grew at a revised 5.2% rate in the third quarter of this year. That's the highest quarterly GDP growth in nearly 2 years. GDP is often used as an indicator of economic health. It means businesses built more warehouses, bought more equipment. Activity contrary to talk of a recession that's been ongoing for more than a year. Back in October, before the measurement was adjusted upward, a member of the Federal Reserve Board, though, called the pace of growth torrid. He said it puts, quote, persistent upward pressure on inflation and stalling or even reversing progress towards the Fed's 2% inflation goal. Here to untangle that word salad and make sense of this is Reade Pickert. She is the Federal Reserve editor for Bloomberg. Thank you so much for being with us. Before we get to the Fed,
thanks for having me.
Before we get to the Fed, let's talk about that GDP number. What does it mean? What should we take away from it?
Absolutely. So what we saw in data out today was that the U.S. economy grew at an even faster rate than originally estimated in the third quarter. And under the hood, we saw that consumer spending wasn't quite as robust as originally reported, but still came in really strong, showing a lot of momentum heading into the final months of the year. But I think the thing to keep in mind about GDP is that it's backward looking. So we're talking about the third quarter, and now we're well into the fourth quarter. So what really matters is what we see going forward. And we're just now starting to get that dribble of data of what's happening in October, what things are starting to happen in November. And that's really what folks will be watching going forward.
And before we get to forward, I still want to look backwards for a second. There was a time when economists were 100% sure that there was going to be a recession. And this has been going on for more than a year. So what happened? And is there anything in those missed and incorrect repeated predictions that should either give us some straight up humility or that tell us something about what's going on with this economy?
I think any economist will tell you that this has been a humbling last couple of years when it comes to forecasting. But exactly, I mean, the economy has continued to surprise some more, even when, this has been perhaps the most telegraphed recession that has yet to happen. And what we have seen on Wall Street is, there's a mix of views on terms of folks who still think that 2024 has a recession in store for us, albeit perhaps a mild one. But there's a lot of folks that think that, we've gotten through the hardest part. Inflation has come down a lot. It's not quite to where it needs to be, but it's improved a lot without pushing up unemployment in the painful way that you typically see when inflation gets as high as it did.
Now let's guess about what the Federal Reserve is going to do. So the Federal Reserve has held rates steady, but the concern is that this high growth could spur the Fed to decide, the economy is going too fast, inflation's coming back, we might need to tick rates up again. Is that the thinking? And what would they be looking for? As you say, this is looking back. What would they be looking for going forward that would give them some indication of where the economy really is?
That's still definitely a concern, and it's part of the reason that you've seen a lot of Federal Reserve officials be really careful about saying that they're totally done or that, mission accomplished. They tend to really emphasize that there is a ways to go, and that commitment to that 2% inflation target that they have. But in terms of thinking about what they need to see, we've actually seen the Federal Reserve start to rely a lot more on anecdotes and things that they're hearing from people in their districts rather than the data themselves, just because data like what we saw today, it can be revised. It can often be lagged compared to what's actually happening in the real economy. And we're at a moment where there's a lot of differing signals coming from the economy in terms of looking at the data. And so, for instance, today we saw what's known as the Beige Book, which is essentially a collection of anecdotes from across the country. We actually saw a lot of the slowdown that economists had, been thinking was going to happen in the fourth quarter. We saw, this broad-based pullback in consumer spending on discretionary items. We saw economic activity really moderate. We saw labor demand start to slow and cool off, as well as those price increases, the pace of those really start to slow. At least that's what companies have been telling these Federal Reserve officials in their localities.
As a final question, Reade, then, would I be wrong? And everything you just mentioned, every single indication sounds like what they used to call a soft landing. Is that what did the beige book suggest that?
It certainly did. I mean, I think, from the perspective of the Federal Reserve, they're getting a lot of what they want to see at the moment. And we've started to see, folks be quite, confident in terms of where we're heading. So, for instance, we saw Atlanta Fed President Raphael Bostic today say that he's increasingly confident that inflation's on a downward path and that we're heading toward this goal. And it's part of the reason that we're seeing, this hold that we have seen in interest rates and why interest rates are expected to remain on hold when Federal Reserve officials meet next month at their meeting. But again, I think, they've been very cautious in terms of saying that, that we're done, and very cautious about the outlook more generally.
Right. Reade Pickert, Federal Reserve editor for Bloomberg. Thanks so much for being with us.
Thanks for having me.